Welcome to the Industrial IoT Spotlight, your number one spot for insight from industrial IoT thought leaders who are transforming businesses today. With your host, Eric Walenza.
Welcome back to the Industrial IoT Spotlight. I'm joined today by Clint Bundy, who is the Managing Director at Bundy Group. Bundy Group is an investment bank that focuses on the automation sector. Interesting talk for us today because typically we'll speak with the founder of an IoT startup or an executive from a technology-focused multinational. I'm personally very interested to get into the conversation today, Clint, and learn more your perspective as an investor and advisor of investments in the automation or industrial IoT space. Clint, thanks so much for joining us today.
Thank you for hosting me. I'm looking forward to the conversation.
So before we, get more into the details of the industry, I'd love to learn more about yourself and how you got into this market. I see you've worked in mergers and acquisitions before. Give me just a bit of background of yourself in the space and then how you ended up founding the Bundy Group.
Sure. And again, thank you for inviting me on the podcast today. I'm looking forward to the conversation. Just a background on myself as relates to my work in the investment banking space. I basically grew up in the business. My father, Bill Bundy, founded Bundy Group in 1989, which I would have been in my teenage years at that point. So I had the opportunity at a young age to witness and see my father providing advice to business owners on topics related to mergers and acquisitions and capital raises. And so throughout my sort of teenage and college years, I was involved intermittently with the business. For a period of time, I went and worked in a sort of separate sector, consulting with Accenture, where I was a project controller, but ultimately gravitated back to investment banking because, frankly, it's just where my roots were and what I enjoyed doing. And I did, before coming back to Bundy Group, work in corporate investment banking for Wachovia's mergers and acquisitions group. But ultimately came back to work with my father in our business at Bundy Group, which is kind of brings me to where we are today, which is I've been with the firm for nearly a decade. And we specialize at Bundy Group in representing business owners, companies, and management teams in business sales, capital raises, and acquisitions. As just a bit of a background on me as well as the company.
Yeah, I'm curious. When did your father start getting you involved operationally in the company? So you said when you were a teenager. Were you 14, 15, and he started, asking you to assess a company, or how did that actually happen at the first steps?
Great question. My father was a big believer and still is to this day, is the best way to learn is through experience. And so my father would often ask me or invite me to come along with him to buyer-seller meetings. So a buyer-seller meeting is when one of our clients is selling a business and a potential buyer comes on site to visit the operations, to meet the management team. And there's just a lot of good dialogue and discourse and walking of the facility and a lot of kind of due diligence that occurs. And so much of my teenage years and even college years, I would just kind of tag along with my father. But as time went on in my teenage and college years, he would ask me to do everything from financial analysis on P&L statements to helping him with marketing and coverage efforts to pulling together confidential marketing materials for sell-side engagements, client sell-side engagements we were working on. So that's sort of how I grew into the business over that time frame.
Great. And so we're going to divide the conversation today a bit into, first understanding your business and then looking more a bit broadly at the market. But let's start with your investment hypotheses. So I know you're focused on control and automation and what we might now call the IoT space. But when you first started focusing on the space, I think IoT was not really a term at that time. How did you come to focus on this specific space? And maybe you can talk a little bit about the evolution over the past decade.
One kind of comment I'll make at the outset is the profession I'm in is investment banking, but I'll have to admit that it's kind of a misleading term for our industry because we are not, for instance, a private equity group. We actually don't invest our own capital. What we do is we help our clients find investors or buyers for their businesses. So when you say investment hypotheses, we do look at it like we're investing, but we're investing our time and our energy to advise owners in the space. And so, kind of to your question of the why, how and why did we end up in the controls and automation space, which when I say controls and automation, I'm of course including IoT within that. But it would have been close to a decade ago when actually I was early in my tenure with Bundy Group. We were referred a controls and automation engagement. And at the time, I knew a little bit about the space from my work in Wachovia's M&A group, but I wouldn't say I knew a tremendous amount about the space. But as I worked on that engagement and I built my knowledge base, I realized, wow, this is a fantastic market. And there are a lot of entrepreneurs in the space. There are a lot of family businesses, and there are a lot of companies that are all in need of, or many of them are in need of capital. Many of them are today or will be in need of an exit strategy or of a sale one day. And in some of these are interested in finding ways to grow their system integration capabilities or their technology capabilities through acquisition. And so all of those sort of fundamentals of capital raise, business sale, or acquisition needs play right into what our services are, which is helping those firms accomplish one or more of those goals. And that's kind of brings us to how Bundy Group decided why we wanted to continue to focus on this interesting growth-oriented space.
Tell us a bit about your typical client so we can look at both sides of the table, so the acquirers and then the targets. Maybe first starting at the targets, are we talking about less than 100 million revenue? Do you also cover over or kind of medium and large caps? Are we talking about like mid-America traditional companies, or are you also involved in the startup ecosystem and helping to procure more kind of later stage VC investments? Who does a typical customer look for you?
I'll kind of draw this parallel as when I was in the corporate investment banking world, we had very strict parameters on what engagements we could and could not take. Our bosses sort of outlined a box and said, your client has to fit within this box or else you can't work on it. Well, part of the benefit of having my own company is that I get to sort of define the box. And it can be a pretty big box. We have worked with companies that are on the earlier stage. Just to define earlier, usually we have to see at least some revenue and proof of concept on the technology side in order to work with them. I wouldn't say early stage is necessarily the average client, but it certainly is a client group that we can and do work with on occasion. Probably what's more common for us, Eric, is working with companies that are a little more mature. So I'm going to use revenue and EBITDA as sort of a range. Revenue usually anywhere from 5 million up to a couple hundred million, or EBITDA a million in EBITDA up to 15 or 20 in EBITDA. And so that's a wide range of sizes, of course, but usually we're working with companies in those ranges who are either interested in an outright sale, selling 100% of the firm, or who are in need of a capital partner. That could either be bringing on minority equity capital, or it could be bringing on a majority equity capital partner like a private equity group. As a boutique, I've got the ability to be flexible in situations, and I try to take advantage of that when I can and work with those who interest me and who I feel like have a lot of opportunity for me and the client.
I think that particular market is an interesting one. I've got a friend who's running a IT consultancy, so they build IT solutions typically for larger corporations. But he has a hypothesis, which is that the larger corporations in this kind of era of digitalization are doing fairly well because they can invest the resources to properly educate themselves, research the markets, and develop new technologies. And then the startups are doing okay because they have access to really pretty cheap venture capital, right? There's kind of a glut of venture capital out there, and so a smart startup can get pretty good capital to get running. And then there's this middle market of companies that are not really a startup. They might have been around for 10, 20, 30 years, but they're still a fairly small operation. So they don't really have the resources to invest in redefining their company, long-term bets on digitalization or education of their management team or their employees. And his hypothesis is that these guys are in a tough spot, and he's looking at how his company can help them to digitalize traditional products. And so here we're thinking about a screwdriver. How can you differentiate a screwdriver, for example, by making sure that you're applying the right amount of torque? And can you do that without adding too much to the BOM and keeping it still in the price range of a typical user? I'm interested from your perspective how you look at these categories. Do you also see kind of trouble for these middle tier companies that have been around for a while, kind of out of the startup space, but don't have the scale necessarily to compete? Or do you think they're doing okay? What's your perspective as an investor there? Or not an investor, but an advisor?
It's interesting comments. And I do think a lot of its beauty is in the eyes of the beholder in terms of how different people look at it. I feel like and I agree with the classification of your term, middle market companies, because that's exactly how we look at it too in the controls and automation space. I think there's a tremendous amount of technology and a tremendous amount of talent within a lot of these companies, and it's a very fragmented market. So you've got a lot of family-owned businesses, entrepreneurially owned businesses. Many of them are doing well. They may not be optimizing performance and the technology quite to the degree that they could be because they don't have the resources of a Honeywell or of a Siemens or of an Emerson or of a Halma or any one of the other companies focused on controls and automation, software and hardware or IoT. But they have a lot of positive attributes, and they either need more talent, which we know in this market, talent is tough to find. Technology talent, management talent. They either need more talent, they need more capital, they need access to new markets, expertise, or maybe a combination of all of the above, which fits right into sort of our sweet spot of helping provide these advisory services. But I feel like there's a lot of untapped potential from a growth perspective and an M&A perspective within the controls and IoT market for this middle market class of firms that you reference.
If you looked at this over, let's say, a 5 to 10 year period, would you say that this market is consolidating as the larger companies acquire or smaller companies go out of business? Or is it expanding as startups are maturing into middle market, kind of stable middle market players?
Well, first, just to throw a couple of stats at you, I mean, it's the global industrial automation market today is about roughly $180-some billion market, and that's anticipated to grow to $352 billion by 2024. So you're looking at a compounded annual growth of about 6.5% a year there. So it's a growth market, and so you've got these interesting fundamentals. With a growth market, you're going to have a lot of startup companies who mature pretty quickly in the middle market companies, and even in a few will probably go into that, go from middle market even to the beyond, into the more corporate scale. And then you've got this fragmentation already in the market where you've got fragmentation, you've got eventual consolidation. That goes for any industry, including the control space. So I think, and it's part back to my hypothesis of why we're in this market, is that with the growth and with the fragmentation, you're going to have a lot of interesting activity around both capital raises, for growth capital raises, and you're going to have a lot of interesting M&A activity. And so I'm very bullish on both of those in this space over the next 5 to 10 years, because I still feel like we're in the early phases of the technology evolution or revolution, depending on what term you want to use, in the controls and IoT space.
Okay, interesting. Yeah, 6.5%. That's a good amount of growth to share among the players. So let's talk then about one or two specific cases. I'd be interested in learning how you evaluate a company's situation when they come to you, regardless of what side of the table they're on. What's a good case that we can look at today?
Sure. Well, I think there are a couple. I'll give you more specifics on in terms of names. The other, I'll kind of give you everything but the name just because we're still working with the client. But the first one is a client of ours that was a client of ours called Nextgen, Nexgen Systems, which was sold about a year ago to a Canadian-based company called Averna, Averna. And Nextgen Systems was a company founded by two engineers plus an owner of another business. And the third partner in that was effectively a kind of a silent partner in the two engineers, or I should say a non-operating partner, not silent partner. And the two engineers ran the firm. And Nextgen Systems is a controls and testing services firm. They were working with a lot of Fortune 500 companies on helping them do integration and controls and testings on their systems in their production facilities. The owners got to a point where they grew the company to a fairly sizable scale and were at a point where they sort of said, well, we've got a bunch of different directions we can go here. But one of those directions is that maybe we should consider aligning the company with a larger platform that can help us accelerate the growth more quickly and help us to maybe build out our bench of talent and maybe even get us access to even more potential client opportunities. And so after much discussion and thought and process, the ultimate buyer, and we again represented Nextgen in the sale, was Averna, who sort of accomplished all of those goals for the seller. And interestingly enough, the two engineers are still there today running Nextgen under the Averna name. The third partner, who was again a non-operating partner, was bought out. And it's been a very positive experience for the company. And I think it'll do nothing but continue to grow under the Averna platform. So that's kind of a case study one. And I'll stop there if you have any questions on that.
Yeah, I think I'm looking at this company now. So it's ERP software solutions and then add-ons. Is that right?
Nextgen Systems based in Charlotte, North Carolina. So should be control system integration and testing. I can give you the website. I don't know if you've hit the right site or not.
No. So somebody else is using the name Nextgen Systems. I'm wondering. Yeah, but they're based in Escondido, California.
Right. This one's in Charlotte, North Carolina, and actually, they may be just merged under the Averna site now.
Yeah, must be. They probably gave up the domain.
Yeah, I think that's right, and that probably is a fairly recent occurrence, to be honest with you. But I would go to the Averna's website to really get a sort of an understanding of the solutions and what have you within that space. And this is firm that works around a number of different end markets, including aerospace and defense, life sciences, telecom, and infrastructure. When you look at the Averna site, you'll see that.
So how are you seeing, and you don't need to get into the details for Nextgen if they're not public, but how do you see the valuation of companies in this control systems trending?
Certainly can't talk about the Nextgen deal in specific, but I'm happy to talk about the sector valuations in general. I think what you have to do is divide the controls and automation market up into, really, I define it into three buckets. One is, let's just call it the software and hardware solutions bucket. So companies that produce software solutions or hardware solutions like sensors for the market. The second bucket I would define as the kind of controls and engineering or system integration market. And then the third one I would just go ahead and define as the IoT space. So let's look at kind of valuations or valuation methodology for those three markets. And the first one, which is more of a very straight technology-driven market, usually with a little more mature companies, above $1 million in EBITA historically, you're going to be looking usually off of either some multiple of revenue So that when I say multiple, I'm talking about transaction value divided by revenue. So the multiple is usually dictated by what the market has traded at for other deals. And so for me to sit here and say an actual multiple would be difficult because so many factors go into it. But you could be looking at, deals that trade anywhere from a 1 times revenue multiple up to a 5 or 6 times revenue multiple. There have even been cases where it's gone higher than that. But it's very much a function. The multiple of revenue will usually be a function of factors such as growth of the company, the margins that the company generates, the industries that it services, the differentiation and the proprietary nature of the technology. I mean, there are really a lot of factors that drive valuation. So that's sort of how I would look at the first bucket. The second bucket is more the controls and engineering or system integration market, which is what Nextgen Systems fit into. In that market, the companies are typically going to trade off of a multiple of EBITA, that's earnings before interest, tax, depreciation, and amortization expense. And again, that can be a very wide range, depending on size, margins, depth of the engineering talent. But just to give you a really wide range here, you could be talking of EBIT transaction value to EBITDA multiples of 3.5 times up to double digits in terms of 10 or 11 times. And EBITDA multiples could go higher depending on the situation and fit with the buyer, and frankly the competitive nature that you can drive in a bidding process, which is what we do for clients in helping represent them in a sale or capital raise. And then the third bucket is the IoT bucket.
Can I just stop you just for a sec? Why the difference in valuing companies' EBITDA versus revenue across these two categories?
Between those first two that we talked about, one of the main reasons that you're going to see a technology-driven company trade in a different valuation multiple methodology versus a control system integration and engineering company is because two main reasons I would point out, actually. One, you have a product that the company owns in that first category. They own the software, they own the code, they own the product, and they manufacture it. It's theirs. It's not solely dependent on who walks in the door every morning to work because there's a real product built. And the second reason is that these technology-driven companies usually have a recurring revenue nature to them, either under a subscription model or a licensing model that oftentimes a controls and engineering and system integration company does not have. And that's a big fundamental reason why you'll see valuation multiples be higher for a technology-driven firm versus an engineering-driven firm, which is historically, by the way, a little more project-driven in its revenue.
And then this third one, the IoT space, is interesting because I think, at least from my standpoint, it's still not particularly clearly defined. There's still a lot of loose ends in terms of what the IoT market would include. I'm interested in your perspective on this.
The IoT market, to reference a comment you made earlier about IoT, it didn't even exist 8 or 10 years ago. It is a growth market. It's an earlier stage market. Now, when I say earlier stage, that doesn't mean there aren't companies with scale in it. But if you were to look at the market as a whole, and if you were to look at the historical transaction comps, when I say comps, I'm talking about the deal comparables, which showed trading multiples. It's really tough to find a critical mass of trading comps in this space. So, and then you reference the fact you've just got a lot of companies in this market that are still very much in growth mode and are not anywhere close to maturity. So what I would tell you is that you're going to probably look at valuation off of a couple different ways for these companies. One is you can use a multiple of revenue, although if these are firms that are growing, first, they may or may not have a great amount of revenue, historical revenue under their belt, so that makes it difficult. And two, they may be growing at such a rapid rate on an annual basis, you have a really difficult time figuring out which revenue do you use. So there ends up being a lot of negotiation between capital groups and the target company about what revenue do we use and what revenue multiple do we use. But that's one way you can value it. The other way is using discounted cash flow methodologies. So that's really where you take sort of the company's projections of performance over the next 3 to 5 years, and you discount that performance back to today. And usually you're discounting the cash flows back to today to get a present value of the company today. Now, there are a lot of variables that go into that analysis. And as you can imagine, there's a lot of negotiation that goes into it to determine, well, what is the actual value today based on the present value. And then there's always kind of a hybrid mix of using a mixture of both present value and revenue multiples. And then deal structuring comes into play, which is there earnout involved in a deal? Is there equity retained by the selling owners? So a lot of factors go into the blender to get to valuation on an IoT company.
Thanks for the detailed overview. You mentioned another project that you're working on right now. I know that there's a lot of details you can't share about that, but maybe you can give us a quick brief on the scope of the project.
Sure. Yeah, I'm happy to. This is a firm, the owner, we've had a relationship for a number of years. And in some ways, this is a very common situation for us in that this is an owner who over 35 years has built a very successful controls and automations business. He actually used to work for a much larger controls and automations company before coming back and starting his own firm in the controls and automation space, has built it into a very successful controls software and hardware firm. So the firm has its own software and hardware solutions, which they sell into the building and automation market. They sell into the wastewater market, and you sell into the government facility market. Just to give you an example, his products are in several military bases in the United States, as well as a major aerospace and defense facility. But the owner has built a great management team underneath him. He spends a lot of time at his beach houses because the management team effectively runs the company. But he's at a point where, first at his age, he needs to think about legacy planning and estate planning. And he also wants to get the management team, who's still very young and hungry, wants to get them aligned with a much larger either platform or private equity group who can support them in further growing. He feels like this company could probably be 4 or 5 times the size it is, but it's got to have the right capital partner. And so we are running a process to help find the right buyer, whether it be a strategic or industry buyer or a private equity partner to acquire the firm.
Have you seen a lot of cases of management buyout in the space? Doesn't sound like that's necessarily the case here, although he might be thinking also about compensating his management team through an acquisition or an outside investment.
Yeah, it's an interesting comment. The management team, actually, there are 3 key managers in this business, and they own 30% of the company. He gave them, they have been so good to him that he's given them 30%. And your term management buyout, it's a good term to use because it is quite possible this could be a management buyout. And when I say management buyout, what I mean is that management could partner with an outside capital provider to buy out my client's 70%. And that option is certainly on the table here. My guess is what's going to happen is one of 2 things. Either we're going to find a strategic or industry buyer who buys out 100% of the company. The management team takes employment agreements, which incents them to grow, and they'll be paid attractive bonuses and what have you. Or we'll have a private equity group buy the company, and management may take some cash off at the closing this go around, but will probably retain a fair amount of equity in the company, and will take what we would call a second bite of the apple when the private equity group 5 or 7 years down the road resells the company. At that point, management will get that second bite of the apple. So it could be one of those 2 situations. Ask me in a few months and I'll tell you what happens.
Thanks for that overview. I think now we have a good idea of who you're working with and how you support them. In the next episode of our conversation with Clint, we'll discuss the market from the perspective of an investor. You can learn more about Bundy Group in the meantime at www.bundygroup.com.
Thanks for tuning in to another edition of the Industrial IoT Spotlight. Don't forget to follow us on Twitter at IoT ONE HQ and to check out our database of case studies on IoT ONE.com. If you have unique insight or a project deployment story to share, we'd love to feature you on a future edition. Write us at eric.walenza@iotone.com.